On Monday, January 2nd, Tesla reported its quarterly and full year 2022 production and delivery figures. For the fourth quarter of 2022, production was 439,701 total units, and for deliveries, it was 405,278. For full year 2022, production was 1,369,611 units, and for deliveries, it was 1,313,851 units. If we take quarter 4 2022 and compare it to 2021, that's a 43.8% growth, and comparing Q4 versus Q3 of 2022, that's a 20.2% growth. If you compare Q4 2022 versus 2021, that's a 31.3% growth, and Q4 versus Q3 2022, that's a 17.9% growth. If you look at Tesla's production since 2020 through 2022, that's a 64% compounded annual growth rate, meaning that on average for the last 3 years, Tesla grew its production at about 64%. And for deliveries, if we do the same math since 2020, it's a 62% compounded annual growth rate. So on average, Tesla grew its deliveries about 62% per year for the last 3 years. However, if we focus in on the delivery number of 405,000 for the fourth quarter, this was a miss relative to where Wall Street expected the numbers to come in. Wall Street was expecting around 417,000 units delivered, which implies a 3% miss. And if you're a Tesla investor, I recommend you close your eyes, but because of this miss, the stock is down 13.27%, with an equivalent market cap of $337 billion. Now, there is a lot of noise around the Tesla story and its earnings and its potential for 2023 from a demand perspective, China fears, so on and so forth, which makes this fourth quarter call that's coming up on January 25th of 2023 extremely important for Tesla investors. I'm going to show you my model for fourth quarter earnings so you can see where my head is at. Here's a quick snapshot of my model. I have Q3 2022 actuals and my estimated Q4 2022. I'm going to go through my biggest variables that are ending up on these numbers. Feel free to pause the video here if you'd like. I will show this chart later on in the video as well in case you want to pause it there. Let me go through some of my biggest variables and how they're impacting these numbers. First, I'm expecting an average selling price drop of about 5.73%. One of the things that's going to help the average selling price in Q4 is going to be the adoption of full self-driving in the United States. In the fourth quarter of 2022, Tesla opened up the full self-driving program to anybody who purchased it, which I think is going to encourage more people in the United States to try the software. And because this software is basically 100% margin, any additional people that buy that option, that money is going to go straight into margin for the car. It's tough to quantify exactly how big of an impact this is, but I do think it's going to have some positive impact. However, the bigger impacts on the downside are going to be the China incentives that were released in the fourth quarter to try and stoke demand. You had an end-of-year push in the United States with a $7,500 additional credit in preparation for the EV tax credit in the United States, as well as a lower mix of S and X relative to 3 and Ys. Model S and X are more expensive cars, which means it's going to be a drag on the average selling price for the vehicles. Now, some of this may be offset by a higher uptake of, say, the 7-seat Model Y or performance models for the 3 and Y, but overall, this should have a negative impact on average selling prices. However, on the flip side, I expect about a 5.6% reduction on cost of goods sold, or the cost it takes to make the cars. And really here, there are 3 big positives that happen in the fourth quarter. The first one is the Austin and Berlin ramp, which is going to make the cost per car in those facilities cheaper overall. The amount of equipment and people needed to build one car versus 1,000 is the same, so the more cars you can push to those factories, the less cost per car you have. The second one is deflation in the supply chain, which is something Elon Musk talked about on a recent Twitter space. What this means is that any material that Tesla has purchased for their vehicles is going to be lower relative to previous quarters in this year. As the Fed has increased rates and the economy has started to slow, the cost of these materials has come down. Tesla should be able to take advantage of these lower costs in addition to a better ramp in Austin and Berlin, which is going to make the average cost per car cheaper. And the third factor here is a higher 3 and Y mix in the cost. Model 3 and Y are cheaper to produce than Model S and X, which means that the total cost per vehicle is going to come down because of the higher mix of 3 and Y. And so if you combine those two things together, a lower ASP but a lower COGS, I'm still expecting a 0.1% drop in auto margins versus Q3, which means that the net profit per vehicle sold should be about the same in Q4 versus Q3 based on my estimations. If you enjoy what you're seeing so far, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you very much. Now let's look at some wildcards that could appear in Q4 that could drastically impact earnings. The first one is energy ramp. One of the big things that was mentioned on the Q3 earnings call for Tesla is that they they now have all the necessary batteries to really ramp all the products that Tesla wants to ramp. And there's been a lot of rumors around significantly higher output out of Lathrop's manufacturing facility for energy for Tesla. In theory, we should start seeing this impact in the fourth quarter of 2022. Because of this additional ramp, I'm going to assume a 23% revenue growth for energy and an increase in gross margin to 12.7% versus 9.3% in Q3. This is still quite small compared to the rest of the business, but if we get some indications from the company that this is going to continue onwards, this implies that over time, this is going to become a much bigger piece of the pie. And the last wild card I'm looking for is going to be the full self-driving deferred revenue of about $1 billion. Tesla hasn't been able to recognize the full amount of the revenue they sold for full self-driving in previous quarters because it wasn't yet in wide release. I expect with full self-driving going wide release in Q4 that they'll start to recognize that revenue 100%, which implies about $1 billion of deferred revenue that they couldn't recognize before that they can now. However, expect this number to be backed out from analysts because in their eyes, this is a one-time impact and it won't continue moving forward. Now that we've gone through those variables, let me go ahead and review some of the top line numbers. I'm expecting total auto revenue to be $20,770 million, which is an 11.1% growth quarter over quarter. If we layer on energy and services and other, that's $23,945 million or 11.6% growth. For total cost of revenue, I'm expecting this to come in at $17,925, which is an 11.5% growth quarter over quarter. This implies roughly a $6 billion gross profit for the quarter, which is 11.9% higher than Q3. If we back out some small increases from R&D and SG&A, I'm expecting income from operations to come in at roughly $4.3 billion, which is a 16.5% increase quarter over quarter. And this is where Tesla's operational leverage continues to shine. Even though the gross profit from the business is up 12%, the income from the operations, because R&D and SG&A is such a small percentage of the business, is up at 16.5% versus 11.9%. And if we back out interest income, interest expense, provisions for income taxes, and so on, the net income to stockholders, which is the bottom line number, I'm expecting to be $3,937 million, or a 19.6% increase quarter over quarter. This correlates to $1.23 adjusted EPS, or a 17.6% growth quarter over quarter. And if we take that $3.9 billion net income number and compare it to today's market cap for Tesla, this implies a 20 price to earnings ratio on Q4 2022 annualized earnings, which is by far the lowest in Tesla's history. I'm not going to tell you to buy or sell or hold. I'm not here to give investment advice. I'm just saying this is the lowest price to earnings ratio for the company. And it's going to be really interesting to see if value investors are now going to start looking into Tesla stock moving forward, especially if Tesla can continue its earnings into 2023. Now, in addition to the earnings report on January 25th, here are the things I'm going to be looking for in the call and in the letter that's going to be released on the same day. I'm going to be looking very closely to what sort of delivery guidance Tesla is going to give for the full year of 2023. They've repeated a 50% year-over-year guidance for the next few years, but I'm curious to see if that shifts in a recessionary environment, or given that the year-over-year growth for 2022 versus 2021 was significantly less than 50%, coming in at roughly 40%. This is going to be huge for people that are expecting some sort of growth into the future. Next, I'm going to be listening very closely to their verbiage around Berlin and Austin ramps, which is going to be great for economies of scale, in addition to the ramp of the 4680 battery cell. As these things continue to grow, the cost per unit that Tesla produces for the vehicles is going to come down dramatically. I'm also going to be listening very closely to their verbiage around deflation in the supply chain. Elon has been very outspoken about the Fed reducing rates because he's seeing a lot of deflation in the supply chain, which means that the costs of producing a vehicle will come down as well. And since Elon Musk has been very confident around his verbiage for full self-driving, I'm really going to be looking forward to hearing how they think the adoption for this software is going to continue into 2023. And all of these points really coalesce around vehicle gross margin. There's been so much talk around recession and how this could impact Tesla's demand. If Tesla's demand is impacted, this implies a lowering of sales price to the customer. But as deflation kicks in and economies of scale kick in and full self-driving adoption kicks in, these should be offsetting measures for gross margin for the vehicles. So I would love to hear more about how these things will offset into the future. Is Tesla going to be able to keep its margins moving forward, or are these going to be impacted as these recession fears grow? And the last one, which for me is the biggest wildcard, is how energy is ramping. If Elon's prediction is correct that the energy business will be just as large as the car business and they can uphold similar gross margins, this implies that Tesla's earnings should double over time. And now that the company theoretically is no longer supply constrained from a battery perspective, I'm really curious to hear how this business is actually ramping and what to expect in 2023. And if this were the case, I'm curious to see how the market's going to start valuing this business. But I would love to hear your opinion. What do you think? How do you think Tesla Tesla's quarter 4 is going to come in? Do you think it's going to beat? Do you think it's going to miss? Do you think people are going to be disappointed? Is the stock price going to continue to get hammered? I would love to hear your opinion in the comment section below. If you want to talk about this or many other topics with our awesome community in our private Discord, consider becoming a patron or joining through YouTube right below. And if you'd like to support the channel by purchasing some merch, just like the shirt I'm wearing right now, consider doing that as well in the description. Thank you so much for watching. I hope this was helpful and I hope this was informative. We'll see you in the next one. Take it easy, everybody. Bye-bye.